Parag Parikh Mutual Fund has come out with a new dynamic asset allocation fund. This category is also popularly known as balance advantage fund, but it is a bit different from the usual type of balance advantage fund. So, what does a typical balance advantage fund do? It uses derivatives to switch between equity or debt depending on the fund manager's view. In case of Parag Parikh Balance Advantage Fund, it will be predominantly and practically speaking a debt fund. It will maintain a 35% gross exposure to equity. Why? Because funds that have between 35 and 65% gross exposure in equity, they are treated under the old taxation regime for debt mutual funds, which is favorable, where the long-term capital gains after 3 years is 20% with indexation. Other kinds of debt funds do not get this advantage. So this is the main feature, the main plus point of this fund. Apart from this, there is also the unique structure that Parag Parikh is bringing to the fund. So the fund house will deploy about 10-15% of the scheme's assets in equity, that to PSU stocks which have high dividend yields, as it has done in the conservative hybrid fund. Just to give you an indicator, the returns of the conservative hybrid fund, whose portfolio is supposed to be quite similar to this new fund, they are as much as 10.5% since inception and 16% over the past 1 year. Now, this has been rather unexpected, and this was not the design of the fund to give such spectacular returns, but it just so happened that the PSU rally massively occurred in the past year and it lifted the returns of this fund. So, going forward, this may not be replicated, but just to give you some context, the fund, the conservative hybrid fund has done very well historically, and this new fund is supposed to have a very similar portfolio to that one. In fact, there is a possibility that the conservative hybrid fund may be merged with this Parag Parikh Balance Advantage Fund or Dynamic Asset Allocation Fund. Same thing. Now, the other big plus point of this fund is that typically balance advantage funds make extensive use of derivatives to create arbitrage. So they normally keep 65% gross exposure in equity because this brings them under equity taxation. And then they use derivatives to bring down the effective equity exposure to 30, 40, 50%. This acts often as a drag on the returns because derivatives or arbitrage returns are similar to liquid fund returns. They're a little less than long-term debt returns, and Parag Parikh has chosen to go more with long-term debt than with arbitrage. It will use some arbitrage to bring down effective equity from 35 to 10-15, but it's a lot less than what normal BAFs do. To speak on downsides, the main downside of this fund is that compared to a debt fund is that it has some equity, it has some arbitrage, so it's going to be more volatile than a typical debt fund. But if you hold it for periods of 3 years or longer, this may even out this volatility and you get the benefit of favorable taxation. Thank you.